Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 163 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, we are going to be talking about the market and outperforming the market and whether or not outperforming the market is possible. If so, how you can do it, and why many people in many situations maybe shouldn't even try to be outperforming the market, specifically the stock market. So we'll dive into all of that and more in today's episode. But before we get started, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcast, then be sure to subscribe and leave me a review on either one of those platforms, and that'd be greatly appreciated. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to stay accountable to a financial plan, help you create a financial plan that's specific to your life and your family's current situation, and work with you on that plan over the long term, then I can do that. Just go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. Now, when we talk about the market, right, when we talk about the stock market, typically what are we talking about? Typically, we are talking about some stock market index. And some of the major indexes or indices that we work with and that we pay attention to on a day-to-day basis are the following. So many of you have heard of the Dow Jones Industrial Average, right? Or the Dow, right? You'll hear the Dow went up, 100 points today, or went down 50 points today, right? The Dow Jones Industrial Average is an index that is made up of 30 United States large cap companies, right? These are large companies. The Dow is typically a pretty stable stock market index, and these are mature firms that are in this particular index, and we use this a lot of times as the market. Now, this is not the most commonly cited index when we're talking about the quote-unquote market, right? Typically, the index that we will use, and we're going to use as our main benchmark in today's episode, is the S&P 500, the Standard & Poor's 500, which is approximately 500, and I say approximately because there can be more by a couple or there can be less by a couple. So it's 500 approximately companies from the United States that are all large companies. And this particular index is seen as the market and is used as the main market benchmark because it is better diversified than the Dow Jones because there are 500 companies instead of just 30. And these are the biggest and brightest companies in the United States. And that is what the S&P 500 is tracking. It is tracking these 500 approximately companies, and it is tracking their performance over time. Then the third index that is very commonly seen on CNBC and very commonly stated is the NASDAQ, right? And the NASDAQ is another index that is made up of primarily smaller companies and companies in the technology spaces, right? So they have a little more slant towards specific types of companies, and these companies are typically more volatile than both the S&P 500 and the Dow Jones. And so typically this is not seen as the best market index when you're talking about the broader market because it is more specific to certain types of companies. And then there are also very broad market indexes like the Russell 2000 or Russell 3000, and that's 2,000 or 3,000 companies that make up the quote-unquote stock market. There's the Wilshire 5000. There's all of these large market indexes, but the one that we will use in today's episode, because when we're talking about investing, we're typically talking about domestic investing. We are going to talk about the S&P 500 when we talk about beating the market. So can you beat the market? Can you beat the stock market? Can you outperform the stock market? Well, what does that even mean? Well, it means, can you earn a higher rate of return on your investments than what the stock market would provide you, than what an index fund would provide you? And what's an index fund? Well, it's just buying some mutual fund or ETF that tracks whatever index you're talking about. So there are S&P 500 indexes. There's one Dow Jones ETF that I know about. There are ETFs that track the NASDAQ. But the most common by far when it comes to index funds that you can invest in is the S&P 500 index. Just about every major mutual fund and ETF provider has an S&P 500 index that's extremely low cost that you can invest in and just put your money away there. And the benefits of doing this is you don't really have to think about it, right? Index fund investing, you don't really have to think about it. You just put the money away into the index and you'll make whatever return the market makes over time. And historically, the stock market has performed quite well. The S&P 500 historically has been around 10% per year when it comes to long-term returns. Okay. Now, this said, there are other things you can invest in. Obviously, you don't have to invest in index funds. You can buy your own stocks, right? You can choose stocks that you want to invest in. You can choose other types of mutual funds that you want to invest in. You can choose different types of ETFs that you want to invest in. You can invest in certain sectors. You can invest in different asset classes, bonds or commodities or whatever it may be, right? You can invest in all these different things. But the question is, in doing so, can you actually beat the market? In doing so, is there a possibility that you can make higher returns? Because the only reason that you should make your investing more difficult, the only reason that you should make your investing more complex than just buying an index fund is if you believe you can make higher returns than just investing in an index fund. Or you believe that there is a better risk-return relationship. Because for some people, a stock index fund is not going to be indicative to the risk profile that they have. So they may, alter their asset allocation maybe towards bonds or more towards other types of fixed income that are not indicative of what the stock market does. But the whole idea is that you want to make a greater return than the S&P 500 or the market if you are picking your own individual investments. Otherwise, why would you do it? Otherwise, why would you invest in anything but an index fund? Well, I have good news and I have bad news. The good news is that it is possible. The good news is you can learn from people who have done it and you can try to make it happen for yourself. And we'll talk about how here in a little while. But you can do it. The bad news is that it's really hard to do it, okay? It's really hard and really unlikely, okay? And so let's talk first about how unlikely it actually is that you can beat the market. And we're going to start with talking about actively managed mutual funds, okay? And so there has been research done, and these reports are up to and through the year 2019, right? So we're looking about a year back when it comes to performance. But over the long term, these trends have held. So I don't want you to think that I'm cherry picking. This is 100% the case. According to this report from Standard & Poor's, 88.99% of large cap, meaning large companies, large capitalization, their market capitalization is large, right? Large cap U.S. funds have underperformed the S&P 500 index over a 10-year period. 88.99. That means that only 11.01% of actively managed U.S. large cap funds have beaten or even equaled the S&P 500 over a 10-year period. So this is quite the revelation. This is saying that even portfolio managers and mutual fund managers who are paid to do this, who are paid to try to beat the market, can't do it over a longer period of time. And even more than that, over a 15-year period, 90.46% of large cap U.S. funds have underperformed the S&P 500. So less than 10% actually outperformed. At less than 10% were actually able to do what we are talking about and what we are trying to do in today's episode. There are several reasons why, right? There are several reasons why this may be the case. Some of the reasons include there's a lack of patience, right? When you're managing a portfolio, you're managing a mutual fund, you are constantly trying to make sure that you can lock in your returns, get your returns over the long term, whereas an index is not doing a lot of buying and selling and in this position or adding to this position or decreasing this position. It's just allowing the market to play out the way that it plays out. And so you end up missing out on more of the upside, right? You end up missing out on more of the companies that continue to do well over time, and companies that do bad enough, right? Or maybe companies that even go bankrupt, or companies that are on the brink of bankruptcy can fall out of an index like the S&P 500, whereas a portfolio manager has to make the decision in order to sell something out of their portfolio in order for you to no longer be invested in it. So these types of things can have a drag on investment returns in these different types of funds. Basically, the whole idea here is higher turnover. The more that they trade, the worse they do. The shorter their time horizons are on their investments, the worse that they do relative to the S&P 500. So it's extremely hard for them to make abnormal returns when it comes to investing in these particular types of funds. That's why when I'm talking about mutual funds, I'm talking about index funds, I'm telling you these things that are probably good for you to invest in. It's a good idea to consider indexed ETFs and indexed mutual funds, because it's hard to find mutual funds that will continue to outperform. Not only is it hard to find ones that will outperform, there's this argument out there that I've heard many times, well, just find the ones that outperform and invest in those. Well, that may sound good to you, but if you look at the research that has been done, just because mutual funds outperform in the past does not mean they're going to outperform in the future. There are very few, very, very, very few that have sustained their outperformance over the long term. And then some of them that did sustain outperformance for a long period of time ended up just kind of falling in line with the market. Why? Because if a fund gets large enough, right, or an ETF gets large enough, it's going to be more and more difficult to try to find investment opportunities external to just a broadly diversified market that would allow you to make abnormal returns, because the more money that you have to invest, the further you have to spread it to try to get the same types of returns. And so it becomes very, very difficult to do so. That's why a lot of mutual funds will make really high returns in their early years, and then those returns will kind of dwindle as the years go on because they will get so large. Because obviously if you're doing so well, people are going to flock to your mutual fund. But that does not mean that you will continue to do well over the long term. Now, that said, you can find perfectly good actively managed mutual funds that will provide pretty good rates of return. But over the long term, are they going to outperform the S&P 500? The answer unequivocally is likely no. And we're not even taking into account here the idea of dividends, right? With the S&P 500, you know you're going to get whatever dividend yield that is offered by the collective companies in the S&P 500. Whatever mutual fund you may be investing in otherwise may not have dividends that are commensurate with those of the S&P 500. Therefore, that is going to eat away at your ability to reinvest dividends and earn more on your investments over the long term as well. And so the odds are pretty stacked against you in order to beat the market in some type of fund when you are trying to invest for your future. If you're trying to find some fund that's going to outperform the market, it is going to be extremely difficult to do so. And it may be good over the short term, 5 years, 10 years, but if you look 15, 20, 30 years into the future, the S&P 500 has a way of just beating down these other funds that try to give it a run for its money. Then for those who have a little higher net worth, they may think that, hedge funds can fix this problem. Aren't they supposed to be trying to just beat the market? Aren't they trying to do this exact thing and outperforming the market on a wide scale? Aren't the biggest and brightest individuals going to work at hedge funds? And that may be true, but are they big and bright enough to beat the S&P 500? Well, in 2008, Warren Buffett made a $1 million bet that hedge funds would fail to beat the market over a multi-year period. In the year 2016, the hedge funds had returned 22.04% on average, 22.04%, while the S&P 500 had returned 85.4%, almost 4 times as much in the way of return. So these hedge funds that are supposed to be hedging their risks, right, and trying to be making returns in other ways apart from traditional investing tactics, they aren't beating the S&P 500 either. Why don't they just invest in an S&P 500 index, right? You would do better if you just allowed them to do that than invest in whatever they wanted to invest in. So it's not just the fees with the hedge funds, it's actually the fact that they can't invest in things that are actually going to outperform the S&P 500. And so that is a big issue as well. Now, all of this said, Here, when we're talking about funds, we're talking about hedge funds, mutual funds, all these things that you could invest in. We are talking about professional investing. We're talking about these professional investors who have to take large amounts of capital, right? Billions of dollars in many cases, and allocate those billions of dollars into different assets and try to outperform the market with those assets. Well, there is an advantage to be had to not be one of these professionals, to not have such a large amount of assets under management. And it's the same advantage that these professionals have when they first get started, and why I said that they can beat the market in the short term, because they have less assets under management, so they can allocate their capital more freely. Well, guess what? As an individual investor, you have that same ability. Now, I am not suggesting that you should be doing this. I'm not suggesting that it is the best idea for everybody to try to go out and beat the market. But I'm saying if this is something that you already do, if you already go out and buy individual stocks, know that you have an upper hand on the professionals because a few things. One, you don't have management fees, right? There are no transaction costs anymore. There's no commissions on trading anymore, right? It is free that you can go and trade stocks or buy and sell stocks that you invest in, and you can make money on those stocks and not have to pay fees. We know hedge funds are going to have really high fees. Mutual funds, especially actively managed mutual funds, are going to have higher fees. Index mutual funds, obviously, the fees are extremely low to zero, right? And so you have no management fees involved in your investing, and so that can help you to make higher returns, obviously. Then there is no career risk, right? If you're investing for yourself and you're not investing with some actively managed mutual fund or something like that trying to beat the market, most professional funds take a cut of the amount of money that they manage, and these funds are incentivized to maximize their total assets under management. But maximizing returns is not as important to them as keeping their job as portfolio manager, right? They take a cut of your money, but they also want to keep their job as the portfolio manager. And when they're getting more and more in the way of assets under management, they just want to keep investors happy. They want to keep investors going and keep them invested, and don't have them pull their money out of the fund. And the way they do that is to become more conservative with their investing approach, to maybe mirror the market a lot more in the way that they invest. This is a career risk, and so if they have a lot of career risk, if they have this want to just get their check and go home and not provide you with the excess returns that you believe you could get, then this can be detrimental to your returns. And you don't have this if you are out trying to invest for yourself. Then naturally, the point I was bringing up a moment ago, you have smaller size, right? The more money you have, the harder it is to beat the market. As a small investor, no one is keeping track of what you're buying and selling, and the amounts that you're trading are way too small to move the market in particular stocks. On the other hand, a big fund that starts buying a stock will often cause the price to move up because the demand for the stock outweighs the supply. And when a big fund starts selling, it can cause the price to go down. Because of this, the sizes of big funds can cause them to have reduced performance. Well, as individuals, we are small. We're not going to move the market. Then we can have greater returns. We can have greater performance than some of these larger funds. Now, they get worse prices when they buy because when the prices go up, as they continue to buy, they buy at higher and higher prices. And when the prices go down, as they sell, they're selling at worse and worse prices. Because most regular investors have very small portfolios, right, this gives you a size advantage. You can buy and sell at better prices. And not only this, right, allocating your money is not as difficult. For instance, I think a lot about Berkshire Hathaway because they're a conglomerate. They go about buying businesses and trying to create returns for investors, even though they're not a mutual fund or a hedge fund. But they're so large that they can't, in their right mind, take a lot of stakes in extremely small companies because they would have to just buy the entire company outright in order for it to have any type of impact on the returns offered to shareholders. And given that they may not want to buy an entire company, they may not want to take control of a particular company, then that can deter them from making certain investments or just make it not worth their time to look at such small investments. And the same goes with mutual fund managers. The same goes with those who are trying to manage a fund. As the fund gets bigger, they are having to purchase things that are bigger, right? They're not able to purchase as much of smaller things, or else they would be, buying up all of it. They would be buying up all of that smaller thing, and that's not what they want to do. There are regulations that are in place that keep funds from buying more than certain amounts of particular stocks. So that is something we do not have to deal with as individual investors. And so naturally, what do we have? Naturally, we have more varied investment options, right? Having a lot of money under management limits the investment options of the managers. Someone with tens of billions of dollars won't be investing in small cap stocks, right? They'll be investing in larger and larger companies as they move along. But you and me can find small cap stocks that can flourish, and we can purchase those stocks and allow them to grow for us and be a relatively good size part of our portfolio into the future if we are trying to beat the S&P 500. Now, stock picking and trying to beat the market on your own can still be a good idea. Again, I don't think it's a good idea when it comes to buying actively managed mutual funds and trying to beat it in the fund investing way, because it's just so difficult to maintain over the long term. Now, don't get me wrong. It is difficult to maintain beating the market on your own over the long term as well. It is not easy. Okay? It requires a lot of diligence and work from you. Like I've told you before, buying individual stocks, if you cannot do your homework, if you do not do your homework, right, then you shouldn't be investing in individual stocks. If you can't put in the time to understand what you're investing in and be investing in it over the long term and understand that you are an owner of a business when you buy a stock, and you should hold that stock over some period of time until the story changes, then you should not be buying individual stocks. This is something that is for the very few who have cool heads, right? Who can do this, who can do the basic analysis, who have the time and can put in the effort in order to make this worth their while. If you don't have the time, or you don't want to put in the effort, or you don't care so much about trying to beat the market, right? Then what should you be doing? You should be buying indexes. You should be buying the S&P 500. You should be buying these Russell 1000, 2000 indexes, these small cap, these mid cap indexes, these international stock indexes, right? You should be buying indexes because you don't want to put as much thought and effort into your investing. And trust me, going with the market is perfectly fine. Making the prevailing market return is perfectly fine. I invest in a lot of index funds. It is perfectly fine to do so. But if there's some portion of your money that you want to invest in individual stocks, you have to be willing to put in the work. You have to be willing to try to pick things that are going to go up in value and maintain their value over the long term. So passive investing in index funds may be the best approach for regular people. It might be the case, right? If you're not interested in the stock market, but you simply want to build long-term wealth to retire on or to do whatever you want to do, index funds are perfectly fine in order to do that. But for people who are passionate about investing, passionate about stocks, want to be able to create abnormal returns for themselves and are willing to put in the work, there's absolutely nothing wrong with picking stocks. Picking stocks it's pretty fun, and it is rewarding as you are to pick winners, right? And don't get me wrong, it can hurt if you pick losers. I've picked losers and I've picked winners. Sometimes those losers sit with you a little longer than the winners do, right? And it's always difficult to determine, hey, when do I sell? Like I talked about earlier, you have to make buy and sell decisions that indexes do not have to make. Indexes don't make buy and sell decisions because they're not selling anything, right? And they're not buying anything. They're just taking the assets under management and investing them like the index is supposed to be invested, based on either the company's stock prices, right, when it comes to like the Dow Jones, or the market cap when it comes to things like the S&P 500. So there's this risk, right, that you could pick losers and you could underperform the market. There's definitely this risk, but that doesn't mean that you have to lose over the long term, right? That's when we have to be able to understand what our investing style, our investing strategy is, and maintain that into the future as we pick companies and invest in companies that we are going to own for the long term. Now, one of the best ways to try to outperform the market over the long term is by looking at those who have already done it. Look at guys like Peter Lynch, who was able to outperform the market by a large clip over the long term as the portfolio manager for the Magellan Fund at Fidelity, right? Look at guys like Warren Buffett, who has done it over the long term, being the CEO and chairman of Berkshire Hathaway. Look at these different types of individuals. Look at people like Jim Cramer, who's on TV every day, but was a very successful hedge fund manager, making great abnormal returns for his clients, even after fees in a hedge fund, which is very rare, but he was able to do so. Listen to people like this. Look at their strategies. Look at what they do, right? If value investing is the way to go, then find some value strategy that you think will work well for you and select your companies that way. If you think there's a growth strategy that best fits your needs, then do that. But always take risk commensurate with what you're trying to do. If you're young and you're trying to grow money for the long term, then maybe you can take a little higher risk and you can invest in some things that might actually, create some really high abnormal outperformance to the market. But if you're in your 40s, 50s, you're coming closer to retirement, maybe you don't want to take as much risk, but you can still attempt to outperform the market. I will tell you this though, and I'll leave it at this today. If you want to know what the bottom line of all of this is, the bottom line is this: you can beat the market. It's hard to beat the market. You can do so based on any number of investing strategies. Many professionals, they fail at trying to beat the market, even though that is their job, right? Well, so that may deter you a bit. And if you are going to try to do it, the fund way is not to do it. Buying actively managed mutual funds is not the way to do it, right? We want to be picking individual assets. We want to be buying things for ourselves, doing it on our own, because we have advantages over those professionals, and trusting those professionals blindly and not knowing who they are or what they do or whatever is very difficult to justify. So I think we should do it ourselves if we are going to do it. Pick individual assets for yourself. I'd like doing value investing, right? Buying things for less than I think that they're currently worth, so they can go up in value over the long term. I subscribe a whole lot more to Peter Lynch and Warren Buffett than to some growth stock investing individuals. I'm very much that value technique, even though Peter Lynch, kind of applies some of the growth stock techniques as well. So I don't want to bog you down too much, but I'll leave you with one more thing. The one more thing I want to leave you with is, if you don't care about outperforming the market, one, or if you think that it's going to take too much time, two, or if you don't think you have the skills and ability to do this on your own, three, invest in index funds. There's nothing wrong with index funds. They will make you wealthy over the long term. What's more important than anything here, because this whole argument is about rate of return. It's about, can we outperform? Can we make a higher rate of return? What is more important than rate of return in every instance is, are you putting money away? Are you investing money in things that are going to go up in value over the long term? Are you continuously feeding your investments? And are you going to have money in the future? And if you put money away, you will have money for the future. 1 or 2 percentage points, even though they can make a difference, aren't going to be so huge in your life that you have to go through all the stress of trying to pick things on your own if you don't want to. Index funds will do you just fine. But if you want to take a little more risk, you want to do a little, something that is both fun and fulfilling, if it's something you enjoy, then picking stocks and picking individual securities for yourself may be something that you could look into. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video. Leave any feedback in the comments down below, and I'll respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, then be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long-form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to create a financial plan and keep you accountable to that plan over the long term, then I can help you do that. Just go to my website, www.MNOwithDylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. So tune in tomorrow as I talk about why your investments cannot go to zero. And you'll see exactly what I mean when you tune into that episode. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.